Good morning and welcome to your Friday, January 17th market news update. Euro Stoxx 50 index climbed to an area last seen before in the early 2000s as optimism towards EU equities returns. Disappointing retail sales from the UK pushed the British pound lower as BOE rate cut expectations rise. China's GDP rate topped estimates in the fourth quarter of 2024, rising by 5.4%. Copper hits two-month highs and marks its second weekly gain as positive fundamental developments in China lift spirits. Softer consumer spending trends reignite calls from money markets for more rate cuts by the Fed. Anti-podium currencies Aussie and Kiwi seek to capitalize on the greenback's weakness and snap their 7-week long losing streaks. Finally, the final HICP update from Eurozone for the month of December serves as the main attraction for Euro traders today. That's all for now, and thank you for watching.
Hi everybody and welcome to another daily presentation. This is the market overview for the 17th of January of 2025. And these are the key events that you should familiarize yourself before starting your own trading day. The first and sole topic of the day is going to be about Chinese growth and more specifically about its expansion, China's expansion and the meeting of the 2024 targets that the Politburo has set back in January of 2024. So earlier today, international investors got another clear-cut sign that the Chinese economy is firing on all cylinders and partially left behind, worries that foresaw the prolongment of its recovery progress and difficulties. So official data showcased that the red giant's economy grew by 5% in the year of 2024, meeting at the end of the day the ambitious target and goal set by the authorities 12 months ago. And we have also seen on a quarterly basis the world's second largest economy managing to expand by 5.4%, topping in a sense the 5% estimate and putting more distance between the 4.6% last quarter's reading. Okay, so we're seeing overall growth of the Chinese economy amidst critical, let's just say harsh criticism that they are struggling in a sense to push up their economic recovery progress away from the COVID-19 pandemic and in a sense stand back on their feet and head forward. We see this kind of progress bringing back optimism in the Chinese economy, albeit all the other problems, the systemic problems that the economy is having. Now, Chinese equities rallied on the back of this data, and we have seen both the Hang Seng and the Shanghai indices heading towards their second straight week of gains. And this rally has started, in a sense, from a recent announcement for at the end of the day, a stimulus measure or another capital injection, more specifically into stock markets, in order to revive this buoyancy and start encouraging, at the end of the day, institutions, but also investors at the end of the day, to start allocating money and funds into Chinese equities. So this kickstarted the progress, and today's results, the GDP results, have also amplified this kind of momentum. Now, supporting the moves were also the upbeat results from China's industrial activities, with industrial production more specifically recording an expansion to the 6.2% magnitude on a yearly basis, showcasing resilience and strength. And last but not least, domestic consumption also surprised to the upside, which at the end of the day salvaged a 3.7% rise and signaled to the market that the efforts of the authorities are growing roots, and these kind of sequential stimulus measures and injections that were introduced throughout the year to target this kind of pent-up domestic demand are yielding the expected results. So a green light for equity investors in regards to Chinese stocks. Given this kind of data, we will see how far the rally will go. And at the end of the day, we're going to keep an eye on developments, more specifically commentary, but also reports coming out from the United States in regards to tariffs, because this is the main kind of issue the Chinese economy is expected to face in 2025. How to deal with Trump and his policies kind of issue. Again, we will keep a close eye on these kind of developments, and we will let you know whether something substantial arises. For the time being, we're going to keep this session short, guys. Thanks for watching, and hopefully we're going to catch you on to Monday's session for another brief update. For the time being, take care. Bye-bye. Welcome everybody to another webinar of our series. Today we're going to talk about fundamental analysis once again. We're going to talk about economic indicators. This is going to be the second part. Last week we have discussed what are the key categories of economic kind of data that traders, investors, economists, and all those related with the financial markets are looking upon, at least from the fundamental side. And we have discussed the various categories of economic data that these people, the aforementioned people, are using in order to make their day-to-day decisions and actually capitalize upon the information and the data that is released. We have talked about growth and output categories more specifically, and inflation. In this kind of session, we're going to talk about employment and the consumption metrics. I'm going to do a small overview of what we have gone through so far, and hopefully going to give you an idea of how traders are, at least fundamental traders are looking upon this kind of information, how they position themselves depending on the results of these reports, mainly because they have severe implications, but also importance into their assessment as to how a specific economy is behaving. And therefore, if you identify what factors are affecting that specific economy, you can more or less gauge how the market in general, in broad terms, is gonna target and act given that information in regards to that economy's currency. Okay, so it's going to be primarily focused around FX. You can have these kind of releases, not specifically economic news releases, having an impact on other categories as well, but mainly stems from the FX market, and then it can translate into bond markets or commodity markets or equity markets and all that kind of stuff. Primarily, we're going to be focusing on the effects of this kind of data on the FX market. So fundamental analysis 101, economic indicators. This is the second part. Let's just begin. This is a quick risk warning and a disclaimer. I'm not going to go over this. You can read it at your own time and space. So essentially, I'm going to give you the gist of it. We do not provide any sort of investment advice or investment recommendations within this kind of webinar series that we have. This is for educational purposes only, and the redistribution of the material is kind of strictly prohibited for the time being. That's it. Let's move on. So what we will go over in this session, this is the agenda. So overview of economic indicators. Once again, we are going to do a recap. We're going to have categories of economic indicators, another recap, and more specifically, we're going to target or focus upon the employment and consumption metrics. At the end of the day, what we care about is to understand how these economic news releases affect the FX market. So I'm going to give you the whole thing as we go through slide to slide. Okay, so what are economic indicators? So the definition, once again, is that in a nutshell, this is economic indicators are such as statistics, okay? So numbers, okay? About an economic activity, so broad-based kind of definition here, but you will understand. Since the nature of economic indicators is numerically based, fundamental analysts use this data and indicators, the indicators are actually providing to quantify it, analyze it, and at the end of the day, make predictions about the future performance of a specific country's currency. So essentially, they provide a snapshot, they meaning economic indicators, of the specific economic activity within a market. And if you piece this information, much of this information together, you can create, in a sense, a holistic kind of view of how an economy is behaving, and therefore, from there onwards, you can extrapolate about the performance of any given country's currency. At the end of the day, this is what the essential kind of prerequisite of doing fundamental analysis is, to take pieces of the puzzle and just redistribute them in order to get a holistic kind of picture. Okay, so even if we're talking, for example, how is inflation within the economy behaving, whether that is growth rates or GDP, whether that is the PMIs, the manufacturing or services PMIs, whether that is the NFP in regards to the employment market. We have a lot of economic data sparsely out there together. At the end of the day, we pay attention to pretty much all of this information. And at the end of the day, we do a kind of a summary or a mix-up of this kind of information, and we get a glimpse of how that economy is performing currently or is expected to perform in the near future. That is the thinking process, that is the rationale, that is the approach we are trying to outline from these webinars, okay, to grasp this kind of concept. And from there onwards, once you understand what information is available, what implications does the information have, and how it is affecting any sort of given currency or asset class, this is what we attempt to do, just bring you this kind of idea of how you can use this kind of information to your advantage in order to make predictions, okay? And capitalize upon this by actually taking action and placing trades and hopefully making money out of this. Okay, so there are three main types of economic indicators, what we call leading, lagging, and coincident indicators. We have talked many times about this, no need for me to go over this. Essentially, the difference is that leading indicators are telling you about a specific aspect of an economic activity within a country, okay, and they're telling you what is going on currently right now or what is expected to happen given those opinions or surveyed kind of opinions that are gathered by those that are in charge in a sense to make a difference. Okay, for example, purchasing managers. Okay, so PMIs are indeed a leading kind of indicator. Lagging indicators are inflation and GDP, which again, as the name suggests, they compile information about what has happened in the past. So we're not talking about right now. Okay, we're talking about what has already happened. So you see the point here, it has to do with time. Okay, where we are in this point in time. And as you know, the markets are, yes, I'm not going to say efficient. They are attempting to be efficient. For all the information, I do assume that it's already incorporated in prices, but pretty much most of the time is not the case. We see adjustments accordingly, and the expectation theory that you look into the future. I can't say. Sorry, boys, once again. Apologies for this. So, yep, that is the nature of leading and lagging indicators. Let's move on to the next slide. Categories of economic indicators. Economic indicators can, at the end of the day, be classified into 4 broad categories. At least that's my personal view of categorizing this kind of information. You can have 5, 6, 7, 3, whatever. Doesn't matter. The point is to separate them with enough distinctions in order to cover a wide spectrum of data. And at the end of the day, once you split them and look at them more specifically, then you can add them all together and get the holistic view of how an economy is behaving. That's the whole point. Okay. So these categories include growth and output metrics, inflation metrics, employment metrics, and consumption metrics. Okay. So today we will focus particularly on the last 2, namely the employment and consumption categories, going over the key metrics that fall under each, describe them, and interpret the readings in an attempt to understand how they affect the FX market and their respective countries' currencies. That's what we're trying to do. Growth and output we have covered so far. Inflation is another one. Today, employment and consumption. Okay. So employment metrics, one of the most important kind of economic indications that are out there. Today, more specifically, we have NFP, and you will see how can that affect, how that result can affect the trajectory, more specifically, of the dollar, bonds, equities in the United States, trajectory of the precious gold. Okay, so let's just begin. So one of the most important indicators when it comes from the employment kind of umbrella is the unemployment rate. Okay, so it measures the number at the end of the day of unemployed people, so as a percentage of the labor force. How many people are not working currently compared to how many people there are in the economy and are actually widely available and ready to work. Okay, so it gives you an indication of how efficient a market is in regards to yes, creating jobs, but also filling those jobs with willingly enough people to go ahead and just go and get to work and make money, and therefore that's how it affects the YA economy. So more people you have in your economy that are actually employed, more people are going to be receiving money or compensation for their exchange of time for work. So if you have enough people or many people in the labor market working towards a goal, whatever that goal is, that they make money, they get compensated, and therefore if they get compensated, you make the assumption that they're going to go out and spend. Pretty much nobody can live without spending, so in this day and age. So the spending aspect, if you have enough money, the spending aspect is indeed important, because mainly most of the developed nations around the globe are driven by at least a contribution to the GDP is by consumption. So the more people spend their hard-earned money on buying stuff and services within that specific economy or wherever that economy is, that means it fuels this kind of positive feedback loop of a cycle that is going to create more. The spending is going to create much more better product and more product in general. Never mind the better. So more products are going to be created. More people are going to be setting up businesses there in order to capitalize upon this kind of positive kind of cycle because there is demand from the people of that nation to go ahead and spend. So that's going to create a positive feedback loop of new jobs once again. And the higher the number of people that are employed within the economy and they get compensated for their work, okay, the more they spend and more they spend, this creates this cycle as just mentioned. So it's contributing directly to the GDP of the country. So good GDP means investors from abroad want to set up businesses in your economy, capitalize upon this growth phase, okay, and that promotes economic prosperity, if you like, okay. So this is a cyclical kind of thinking. So the higher the unemployment rate, the worse it is, and the lower the employment rate is, the best it is, okay. So in simple terms. So one thing to remember is that the rate is not measuring the unemployment in the passing of time, but is more like a snapshot of the current situation, or if you prefer, the month it relates to. Okay, so it's not a historical kind of thing. We're talking about in that specific month, how many people were employed and how many were not. How many were not, divide that by how many people are actually available in that economy to work. You get the percentage kind of how many people are indeed working or not. So interpretation, usually a rise of the unemployment rate could be a negative signal for a currency, and that's the reason we're going to discuss the reason why, because it relates to, as that would imply that unemployed people have risen in relation to the total workforce with possible adverse effect on the growth rates of the economy. Okay, so more people that are unemployed, less people are going to be available or willing to spend money in the economy, less spending in the economy, less consumption in the economy. That tends to, I just say, weigh down the growth aspect of the economy because businesses are not working as efficiently as they could. International investors are not willing to invest money in an economy that people are not willing to work, or there is a high degree of unemployment rate. So therefore, that creates a negative feedback loop, which leaves international investors out of the economy, and on that kind of thing, domestic investors just flee onwards to other economies to capitalize upon their better compared to their domestic economy. So therefore, you see this fleeing capital. So they sell their domestic currency and they buy something else to facilitate or create at least the required return on investment on their back. Okay, so that's how it affects the currency of that specific nation. So at the end of the day, high unemployment rate means a bad signal, not good for the economy. Most of the time, you're going to expect to see lower GDP. If you see lower GDP, most likely you're going to see a weakness of that country's currency because people are fleeing away from this weakness of that country and they're going somewhere else, which is better. So low unemployment rate is a positive signal because it signals growth within that economy. That country's currency most of the times is getting a boost because we see flow of funds from abroad into this economy for them to capitalize upon this growth opportunity. So there's more demand for the domestic currency compared to the other one. Okay, they are exchanging their money for. So they are selling, for example, Australian dollars in order to get the US dollar and set up their businesses in the United States. Therefore, the value of the dollar goes up. Okay. So we have here the unemployment rate of the United States for the month of October last year. So we see again how to read this. This is an economic news release. That's a snapshot. So the previous reading was 3.5%. Forecast was it for it to rise to 3.6%, so a tenth of a percent rise. So more people are becoming unemployed within that period of time in that October month. The actual result was even worse than that. So more people than expected were unemployed in that month. So that is bad news for the United States economy. Therefore, at this point in time, in this kind of release, you would have expected to see some weakness for the United States dollar, mainly extrapolating from that rationale I just mentioned a few moments ago. Okay, so but at the end of the day, we also do care about the historical kind of trajectory of any given economic indicator, not just the unemployment rate, in order to get, again, the holistic kind of view. Yes, the unemployment rate has risen from 3.5% to 3.7%, but if you look the curve right here, You see that was back in the area around the period of COVID, so high unemployment rate because businesses were closing down due to the lockdowns. But from there onwards, you see this steady decline of the unemployment rate. That means more people went back into the workforce because we have seen the pandemic kind of rules or restrictions kind of being lifted off because of fears that we're going to have a recession if enough people were unemployed. And since then, we have seen the unemployment rate kind of easing down to 3.5%, 3.6, so below 4% for a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months or a year or so. So the situation was kind of moderate, and you can clearly see from before the COVID pandemic, the unemployment rate was kind of ranging somewhere in there. Maybe you got a reading of 3.2, 3.1, whatever that is, but we're talking about a historically average low. Okay, this 3.5%, even though 3.7%, even though it's a uptick from the current month, at the end of the day, it's a historically low kind of reading compared to that with the COVID-19 pandemic, which you see skyrocketing effects. Okay, so the reaction wouldn't have been as grave as the time we have seen the unemployment rate shooting up to 15% back 4 years now. Okay, so again, keep that in the back of your mind. Not only does it matter for the month-on-month level, but look at it from a historical point of view to see whether it makes sense or not. So if you see a rise of the unemployment rate now going from 3.7%, which has actually gone up from, and heading higher than the 4% and 4.1 and 4.2 or whatever that is currently in the United States, around 4.3%. So you see a rise once again. That is possibly a signal that the US labor market is losing its tightness. Okay, so that is a problem from the United States, and you reasonably expect to see outflows from the United States dollar, outflows from the United States equity markets. And since you have this kind of fear for a recession because of the rising unemployment rate, most likely you're going to see some inflows going towards the precious metal gold. Okay, so hopefully this is understood. Let's move on to the next. So non-farm payrolls, the most important after the unemployment rate. So NFP figure, short for the non-farm payrolls, is a key indicator used primarily for the US employment market, despite being also used for other countries as well. So it measures the change in the number of people employed during the surveyed month, excluding the farming industry, hence the name non-farm. And the reason why you exclude the farming industry is because the farming industry as a whole relies on the high seasonality effect. For example, you do have apples throughout the year, but you don't have strawberries throughout the year. Okay, so it's a seasonal kind of item, or watermelon. Okay, so you have that during the summer period, but not on the winter period. So in order to eliminate this kind of seasonality effect from the official reading of how many jobs were created, because if you have an item that is in high demand or it's in harvesting period, it's in the summer, okay, and that item or that good is not in the winter, you get obviously a distorted kind of point of view in the summer because you have more, you have that item to be harvested, more jobs will be created in order to match this kind of demand or this kind of harvest. So therefore, you're going to have a skewed result if you have the farming industry, a seasonal kind of industry, into the mix. That's why the non-farm payrolls data excludes the farming industry out of it, okay, in order to avoid this kind of distortion of the event. Okay, so that's why we have the non-farm payrolls figure discussed as non-farm. So excludes that aspect. So practically the indicator is measuring the US employment market ability to create jobs. Okay, at the end of the day, this is what the NFP figure is telling you about. How many jobs were created in this period of time? Nothing more, nothing less. Okay, which is also having an effect on the consumer spending function of that economy. So more people, okay, a high NFP print, that means more people are employed, more money to spend, more money to spend means higher GDP. Higher GDP leads to a stronger currency. Okay, that is in a nutshell what we have discussed in the prior slide of how this kind of rationale comes into fruition. So it is released, the NFP is released every first Friday of every month, and this month is going to be today, the first Friday of September, we're going to have an NFP print, and we're definitely going to be paying a lot or more attention to this because mainly the prior one was, we can call it bad, and that created some volatile distortions in the market in fears that there's going to be a recession. So today is going to be whether we're going to see a confirmation or not, we will see. But yeah, NFP has the ability to create a lot of volatility in the markets. Okay, that's why we do pay close attention to it, because it's directly related to the GDP of the country, and the GDP of the country is directly related to the performance of that country's currency. So yes, it is watched not only by investors, but also from policymakers, US policymakers on the governmental front, and also the Federal Reserve, the central bank of the United States. So everybody pretty much watches NFP. It's a seasonal kind of event that comes every Friday of every first Friday of each and every month. So also worthwhile remember is that the change in this indicator can be very volatile, could create wider market distortions with the ripple effects also felt in the US stock markets. This is what I just discussed. July's NFP print, which was released in the first week of August, scared the hell out of people. So we see short selling activity spiking in the United States market. So downsizing of portfolios given this unfavorable development of the labor market of the United States. So interpretation, once again, should the reading of the indicator rise more than market expectations, we reasonably expect to see the United States dollar strengthening. And this is an example of this. So non-farm payrolls for the month of October last year, previous reading was 315,000. Expectation was, the forecast was for it to fall to the 200,000, which is a historically average kind of reading number. And the actual one was 60,000 more than that. Okay, 261,000 was the actual result, better than expected. NFP print, most of the time, most likely, you would have seen a positive reaction towards the dollar, inflows going into the dollar, and weakness in the Japanese yen, in the commodities market, more specifically in gold. This reaction would have been positive for US equities as well, because companies are directly related with the growth aspect, which the growth aspect is related with employment. And this is how the whole thing unfolds. Okay, so moving on. We also have ADP employment report. We had this report earlier this week. So ADP employment report is another US employment market metric, and is announced every month. It's a private sector kind of measure. It does not include the governmental aspect of things, which is important. Of the monthly change in the non-farm private employment, it is usually released 2 days ahead of the official employment data. So Friday, so most of the times it's on Wednesday, and it is considered to be a gauge of the NFP number, hence the name ADP, non-farm employment. Okay. Analysts tend to advise against interrelating the two indicators. However, in recent times, we have seen this kind of popularity rising back once again after a prolonged period of not being watched at all for some reason. Okay, now it's becoming important, and we have seen it earlier this week. Okay, so it's a sneak peek of what to expect from NFP 2 days before the official release. I'm talking about the ADP here. Okay, so ADP non-farm employment change, previous 192, forecast 195. So a rise was expected, mean a rise by 3,000 jobs in the private sector. Actual was 239,000, so much better than expected. Positive reaction towards the dollar was the most likely scenario here. Okay. Another aspect of the employment market or employer umbrella is the jobless claims. So we have initial and continuing. So the jobless claims figure, also a metric for the employment market, is the number of people who are filing. Okay, so filling in their details to file for unemployment benefits in the prior weeks. So its field is measuring the people that have filed, or actually filing, or have already filed for unemployment insurance benefits the prior week, whether they decided to take a break from work or whether they got fired. Those are going to the official services of the government to file for benefits in order to get some money in order to survive. These people are information is compiled, and we have what we call the weekly initial jobless claims. So there are two categories. We have the initial, the ones that filed for the first time, and the continuing, those that have been on this kind of insurance, unemployment insurance benefits for a prolonged period of time. Okay. So the release is on a weekly basis, and it's indeed a leading indicator because it gives you information about what is currently going on. Okay, not about what has already happened. So interpretation: the higher the number is in regards to employment benefits, in regards to the initial jobless claims, the harsher the reaction is going to be towards the dollar because we're talking about people that are not working. So if less people are working, obviously it's not going to be good for the dollar. So the lower the initial jobless claim figure is, the better it is for that country's economy and respectively that in that country's currency. Okay. So jobs openings, much like the ADP, is another report or a survey, if you would like, that helps keep track of job vacancies available in the US labor market. I'm talking about open positions, so accumulates all the open positions for any given work within the US economy. The higher the number of job openings, that means more willingness, the more jobs are created, irrespective of whether people are actually getting those jobs, applying for those jobs or not. So the creation, okay, of jobs is the important aspect of it. That means because it can attract investors and workers from abroad in order to fill in those positions. That means there are enough jobs for people if they want to work and if they can work to go ahead and grab in order to make money. And if they go ahead and just actually do that, the opportunity of them getting the job is going to create more money for them, and therefore it's going to lead to a positive GDP and etc. 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 We have discussed this many times now. So it collects data from employers about the business employment, job openings, recruitment, hires, and separations. So essentially, the JOLTS defines jobs openings as all positions that are open, not filled, excuse me, on the last business day of each and every month. So last 30 days, how many people, how many jobs were created, how many openings were created, and whether they were filled or not. So a specific position, these are the criteria. So a specific position exists and is there is work available for that position. The first one, the job could start within 30 days, irrespective of if the establishment finds a suitable candidate during that time. There is active recruiting for workers outside the establishment location that has the opening. Okay, so at the end of the day, a higher jobs openings report, job opening report is a positive sign for the economy. Strength is expected to arise for the United States dollar if there are enough open positions. On the contrary, if you see a falling jobs opening market, that means there is weakness in the creation mechanism of jobs in the United States. So that's not a good look. Most likely, you're going to see weakness in the dollar. Okay, so enough about employment. Let's move on to consumption, and we're running out of time. So retail sales is the most important consumption metric. So prime metric when it comes to consumption indicators are the economy's retail sales. What is retail sales? This the number of sales that have occurred within a period of time in that specific economy. And as we just mentioned, consumption is super important because if you do have a strong consumption function within the economy, that means more people are buying stuff, the fact that more people are buying stuff, that means there is a lot of demand for goods and services within that economy. That means more jobs are going to be created to capitalize upon this demand for goods and services, whatever that is, which is going to lead to a stronger currency and GDP rate, etc. Okay, so they measure the purchases of finished goods and services by consumers and businesses, and by measuring consumer demand for finished goods and services, retail sales help gauge the pulse of the economy. That means the higher the retail sales are of the country, that means more people are willing to spend the money. That means there is a lot of demand for goods and services within that country. If you have a high consumption rate within that economy, most likely you're going to have a strong GDP reading as well, which is going to attract international investors, people creating jobs, etc., etc., etc. It's going to lead to a stronger currency of that nation. Okay. Should be noted that the rates can be distinguished from headline rates, or the plain ones, which tend to include a broader spectrum of products, but also you have the core retail sales, okay, not just retail sales, core retail sales, which may exclude products such as automobiles and gas stations, which are things that are highly affected by energy prices, and therefore they tend to skew the results. So you have a cleaner version of retail sales there. You have the core retail sales number. Okay, so overall, the rates are usually being issued on a monthly and on a yearly basis, and how to interpret it. So an acceleration of the rates beyond market expectation. So you expect something and the actual result is above it. This creates support for the respective currency and vice versa. That means more demand, more people are going to be selling their domestic currencies in order to get, for example, the United States economy's currency to capitalize upon its appreciation of value. Okay, so we have here the release from the United States, the core retail sales. Previous one was 0.1%. The forecast was for it to rise by 0.3% to 0.4%. The actual one was 1.3%, so much better than expected. Strong reaction, positive reaction for the dollar was expected here. Compare that with United Kingdoms and the pound. If you see here, down here, retail sales for the month of September. The prior month was negative 1.7%. That means more people were shying away from consuming, which is not good because it's going to impact negatively the GDP rate of the UK's economy, and therefore you see this kind of slump of the pound. The expectation was it to improve, but not that much, to the negative 0.5%. The actual one was much more worse than the expectation, not as worse as the prior reading. So negative 1.4% negative reaction was expected to be seen from the pound given this release. Okay. So moving on to the next one, consumer confidence indicators. Consumer confidence indicators, excuse me. Another consumption metric is the consumer confidence indicators, which tend to measure, you guessed it, a level of consumer confidence or willingness to buy stuff in economic activity. So practically the indicators are formed by using surveys. So they go out and ask people how they feel about the economy currently right now and whether they are willing to spend more money in the economy. Okay, so they measure their degree of optimism of consumers on the state of the economy. So if the economy is going well and have enough money, people tend to be, and they're actually working, people tend to be more over optimistic about what's going to happen in the future. That means you can have a high consumer confidence indicator, which is super good news for that economy because it fuels this cycle we just discussed many times ago. Okay, so for example, the Eurozone reading is compiled from a survey about 2,300 consumers in their zone, which ask these responders to evaluate future economic prospects. And this is a key word, future. They're not talking about what has happened already in the past. They're talking about how do you see things in the future? Are you confident enough to go ahead and continue spending as you do right now? You are more or you are less. So it's a leading indicator. It gives you information about what to expect from the people that are actually in the economy and they are spending or not their money within the economy, depending on how the economy is behaving in pure terms. Okay, so overall, the degree of optimism or pessimism characterizing the average consumer in an economy may have an impact on retail sales and hence the contribution on the average consumer growth of the economy. Excuse me. So you can see and you can classify consumer confidence as a predecessor of retail sales. So if you're asking people within that economy, what do you think about is going to happen in regards to your own spending? This is going to be the retail sales number that's going to be recorded within those months leading into the future. Okay, telling you about, you know what, they say they are optimistic. Have they actually been optimistic in this month that has passed? So have they went out and spent money? Okay, this is going to be given to you by the retail sales. The actual spending is going to be given to you by retail sales, whereas the expectation or the outlook about what they're going to be doing as consumers in this economy in the next few months, this is given to you by the consumer confidence indicator. Okay, so you understand the importance of it because it's a leading indicator. So should the reading be higher than expected, it would imply a great degree of optimism. Great degree of optimism, that means positive reaction towards that nation's currency and etc., etc., etc. Let's not go into more details than this. You have two examples here of consumer confidence indicators, what we call the CB consumer confidence indicator from the United States, but also the University of Michigan consumer sentiment, the preliminary report, another leading indicator from University of Michigan. Also, both of them super, super, super important. Okay, so next one is current conditions. So as the name suggests, we're talking about what is currently going on right now. Not in the future. They survey people, how do they feel currently in this kind of state of the economy? Okay, so business conditions, however, okay, no consumers, excuse me. So business conditions indicator are being compiled user by surveys that are supposed to show what the current conditions on the ground actually are for businesses, not consumers, the ones that are actually selling the items or providing these services to the consumers. So it's from another point of view, not the consumer, but the producer, if you will, like all the ones that are actually selling the stuff. So retailers, retail shops. They tend to be found in several slightly different variations depending on the economy surveyed and the organization performing the survey. They are released on a monthly basis, and the higher the current conditions number is from businesses, the ones that are actually ordering stuff to bring to their shops in order to sell them to consumers, okay? The higher the current conditions number is, the higher the more positive, the more optimistic the outlook from these businesses is, the more available opportunities are in the economy provided by these businesses, and therefore consumers can go ahead and actually buy stuff. So the higher the number of the current conditions reading, the stronger it is for that country's currency, or at least more favorable it is for that country's currency. Okay, vice versa is also true. Okay, moving on, economic sentiment. This is a much more broader kind of series of questions, of surveyed questions. So economic sentiment indicators tend to measure optimism characterizing businesses in an economy. So if the business is not optimistic about the future, that gives an indication that they expect something bad to happen, something bad expected to happen in the near future. Not going to be good news for the business. If they're not going to be good for the business, that means they're not going to be selling enough, etc., 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 which is going to create less consumption. Less consumption is going to be translated into lower GDP readings, and the lower GDP readings are contributing to the fall of that country's currency, okay, or the depreciation of that country's currency. Again, well, the higher the number of economic sentiment, the better it is for that currency. The lower the economic sentiment result, the worse it is for that country's economy. Okay, so we are nearing the end, if I'm not mistaken. Yes. So economic calendar, where can you find this kind of information? Pretty simple. They're widely available, pretty much everyone, free of charge. These are a few options of where to find this kind of information, not only on the employment and consumption front, we just outlined here, categories, also the economic indicators in and of themselves, but also from the growth aspect of things and output aspect of things on the inflation aspect of things, okay? You can find all this kind of information widely and freely available online, for example, in sites such as investing.com, forexfactory.com, Baby Peeps, FX Street, and all that kind of stuff. Free to use, please go ahead and use them accordingly. This is fundamental data. Please learn how to interpret it. If you have any sort of questions, please send them through right now. I'm more than happy to answer. But yeah, this is the fundamental analyst kind of point of view. They look at reports, they look at economic news releases, and they create predictions about what's going to happen in the future given the current data they have. Information they get from is from the economic calendar, which has all this information. Such websites are invested.com, Forex Factory, Baby Peeps, FX Street, etc., 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 many of them. Okay, so don't see any sort of questions. So again, guys, I'm gonna have to finish the session here. If you do have any sort of questions popping up after this kind of webinar, please send them through to the email I've just provided on our first webinar. Contact me. More than happy to answer these kind of questions for you. But yeah, we're gonna keep it here. Thanks for watching, and we're gonna see you hopefully next week for another episode of our series. For the time being, Gonna leave it here. Thanks for watching. Take care.